This is the second of two videos on accounting for receivables. In this video, we're going to be focusing on notes receivable. So a note receivable is different from an accounts receivable in that an account receivable is typically going to result from a sale on account. It's usually non-interest bearing and is usually very short term, as in 30 days or less. A note receivable can be 30, 60, or 90 days, but it also could be 3 or 5 or 10 years. So notes receivable can be short-term or long-term. A note receivable is also generally going to be interest-bearing. A note receivable is considered a more formal legal obligation than an accounts receivable because it's evidenced by a promissory note, which is the document that is signed by the two parties to the note, the maker and the payee. The principal of the note, or the face amount, is the amount of money that is borrowed. The interest rate is going to be specified as an annual interest rate, and the promissory note would also specify the maturity date. So our example here, on February 1 of 2022, Wonder Company sold merchandise and accepted a 90-day promissory note in the amount of $25,000 from Neon Company with an interest rate of 10%. So in this situation, Neon is the maker and Wonder is the payee, meaning the party who's ultimately going to get paid. The principal or face amount of the note is $25,000, and the interest rate, which is by law expressed as an annual rate, is 10%. So in recording this journal entry for the sale and receipt of the note, we're going to debit notes receivable and credit sales revenue for the face amount of the note, or $25,000. So do note that in this situation we are focusing on the books of Wonder, who is the seller/lender. When you loan money on a note receivable, you are going to earn interest revenue. So the sale took place on February 1, and we can calculate interest by saying interest equal principal times rate times time. We know that the principal is the $25,000, the annual interest rate is 9%, and if we wanted to calculate the total amount of interest revenue that Wonder is going to earn, we're going to multiply that times the fraction 90 over 360. So here we're kind of making a simplifying assumption that every month has 30 days, and if it's a 90-day note, then we're going to want 90 days of the 360 days in our calculation of the total interest. So 9% is the interest rate for a year. We're not borrowing or lending for a year. We're borrowing or lending for 90 days, and that's why we're doing 90 over 360. So when we collect the note, so the original transaction was February 1, so our 90 days would be February, March, April, and so we're going to be collecting the principal amount of the note plus the interest, and when we do that, we're going to debit cash for the total. We refer to that $25562.50 as our maturity value, and we're going to credit note receivable to take it off our books, and we're going to credit interest revenue for the amount of interest that we've earned. So a second example, we have December 1 of 2022, Wonder sold merchandise and accepted a 6-month 12% $10,000 note from Astro Company. We're going to make the same entry to record the sale and the receipt of the note, a debit to notes receivable and a credit to sales revenue. But at this point, we want to note that it's a 6-month note. The sale took place on December 1 of 2022. So of the 6 months, one of those months is in 2022 and the other 5 months are in 2023. So we're going to want to recognize interest for 1 month in 2022 and interest for the other 5 months in 2023. So in this case, we want to figure out the 2022 interest. we're going to say 10,000 times 12% times 1 over 12, or we could have said 30 over 360 there, it would be the same thing. And then 2023 interest is going to be 10,000 times 12% times 5 over 12. So we're earning a total of $600 in interest, but some of it needs to be recognized in 2022 and some of it needs to be recognized in 2023. So that is according to the revenue recognition principle. So 1 month after we accept the note, we're going to need to make an adjusting entry at December 31, 2022 to accrue interest revenue. So if you recall, accrued revenue is revenue that you have earned but not yet received. We earn revenue with the passage of time. We accepted the note on December 1, 1 month has passed. It's the end of 2022. We're getting ready to put together our financial statements, and we want that interest revenue to show up on our 2022 income statement. So we're going to make this adjusting entry. We're going to debit interest receivable and credit interest revenue for $100. So interest revenue of $100 will be reported on our income statement, and then on our balance sheet in our current assets section, we'll report both the notes receivable and the interest receivable. You do want to note that the interest goes into a separate account. It is not correct to put it in with the note. The note is only going to be the face amount or the principal amount of the note. All right, so 5 months later, on June 1 of 2023, we're going to collect the note. So the maturity value is principal plus the total interest earned of $25,600. We're going to debit cash for that amount. We're going to credit notes receivable for the principal amount. We accrued 2022 interest revenue and put it in interest receivable. So we need to take that receivable off the books as well, and then we're going to recognize 2023 interest of $500. Occasionally, a note will be dishonored, which means that the maturity date arrives and it doesn't get paid. In this case, we're going to transfer it out of the maturity value out of notes receivable and interest receivable and put it into accounts receivable. So for our dishonored note, instead of debiting cash for the $25,600, we're debiting accounts receivable for the maturity value of $25,600. We're taking the note receivable off the books. We're taking the interest receivable off the books by crediting those two accounts, and then we're recognizing the additional $500 of interest revenue in 2023. We can also dispose of receivables by selling receivables or pledging receivables. Often a company will want to get the cash before waiting for the note receivable to get to the maturity date, so they can sell the receivables to a company known as a factor. So a factor is a finance company that buys receivables for a fee. The fee is going to be charged to factoring expense fee, and it's going to reduce the amount of cash that we receive. So we would debit cash, debit factoring expense fee, and then taking the receivable off the books. One other transaction would be to pledge the receivables. So receivables can be pledged as security for a loan. The note payable is recorded the same if the note is secured or